Somebody recently pointed out that, yeah, you post all your trades, but what's the strategy? We're just seeing you trade for like a minute and that's it. So, what's the strategy? So, quick backstory is I'm what's called a proprietary trading firm. I trade money for my business and that's it. No retail customers, no clients coming up and say, hey, can you manage my money? None of that. So just like you would go to a bank and say, hey, I need money to open this restaurant, I need money to open this dry cleaner, whatever the case may be, I go to the bank and other lenders and I say, I'm going to trade. This is my business. And that's it. And they either give you the money or you don't give the money. So that's market open. Here's my strategy. Okay. So here's the rationale for the business. Okay, stocks are volatile. We all know that. We use derivatives like options to safeguard against some of the risk and some of the volatility. So I use call options and put options. Okay, a call option is the obligation to sell a stock at a given price. So this is if you sell a call option, you get a small amount of premium, and then I am obligated to sell you at a certain price. Okay, that's going to be important later. A put option, if I sell a put option, is the obligation to buy a stock at a given price on a given day. Okay, sellers of options collect premiums for selling calls and selling puts, similar to insurance. So people will come to me and they will buy these options from me to safeguard their positions. And for about 1% of the premium, or 1% of what the stock value is, I'll sell it to him. So, for instance, if he comes to me and he says, I have $10,000 worth of stock, I need to, I need a put option on it. So you have $10,000 worth of stock, give me $100, and I'll agree to buy it at a certain price. Okay, premiums are based on the level of uncertainty surrounding the stock. So, what this means is if there's a lot of uncertainty, if it's this company doesn't make any money, we don't know what their earnings are going to be, Elon Musk is going to quit tomorrow, whatever the case may be, that will increase the premiums. So that's why I set it at 1%. You get 3, 4, 5, 10% on premium, but why would you want that? Because the uncertainty is insane. If I can keep it 1%, that means it's kind of certain, it's pretty certain that it's not going to reach that level. And I don't have to buy it or I don't have to sell my stock. I just collect a small premium. So it's like selling scratch off tickets. So you may have one or two that hit and you have to pay out, or you have to buy the stock, or you have to sell your stock. But most of them are, you're just going to collect that little bit of money and that's it. And you don't have to do anything else. So that's the business rationale. So here's what a cash secured put is. That's the first play you make. Cash secured puts. Okay? You sell a cash secured put. Say I will buy your Tesla stock at $150 a share for $150 in premium. So you collect that $150 in premium. You say it's not forever. You sell it for a date. 2 weeks, 3 weeks, months, 6 months, whatever. Once that date comes, then you either have to buy the stock at the 150. Let's say it's 149 on that day, then you have to buy it at 150. Okay? If it's 170, then it expires worthless because you don't have to buy it at 150. Why would you buy it at 150 when it's 170? Okay? Then you log your profits and you do it again. You just do this over and over and over and over again. At one point, you're going to get caught and you're going to have to buy the stock. So you sell the cash secured put, collect the premium, wait for the date. It gets assigned. So Tesla's trading at 147. You got to buy it at 150. You're currently holding a 147 stock at 150. So you log the cost basis. So I have Tesla stock at 150. Okay. Then I move to a covered call. Okay. So these are the two scenarios. It expires worthless and I pocket the money, or I have to buy the stock and then I go to covered call. So selling puts obligates me to purchase shares at an agreed upon price if it's below that agreed upon price on the date. If the stock is above the strike price that I agreed on, the option expires, all premium is total profit. I could sell that put again. Okay. If the strike price is below the strike price, if the stock price is below the strike price, the option is exercised, premium is kept. I keep the premium, but I have to buy the stock. Okay. So here's the risk on premiums. The stock gets crushed, absolutely crushed. And instead of it going to 148 and I got to buy it at 150, it goes to 100 and I have to buy it at 150. That is the risk. Okay. So that's why you want a relatively safe stock so it doesn't lose that kind of, doesn't lose that overnight. Okay. And then I could just hold the stock longer. So if I believe in the stock, I would just hold it longer and then sell the covered call when the stock gets closer to my price that I bought it for. Okay. So let's say I have the stock. I have Tesla at 150. Okay. I could sell a covered call at 150. It's currently selling at 148. I could sell the covered call at 150, collect the premium, wait for the date. If it doesn't reach the 150, it expires worthless and it's all profit. And I still keep the shares. Scenario 2, I sell the covered call on the Tesla at 150, collect the premium, wait for the date, and then it's trading at 152. Then I would sell it at 150, even though it's trading at 152. That's the breaks. I log the profits, and I move to sell the cash secured put. So it's just, some people call this the wheel, but it's kind of a modified wheel. So you're just going in these circles, collecting premium, selling, buying stock. Okay? So selling calls obligates me to sell shares at an agreed upon price if it's at or above that price by the agreed upon date. There are two possible outcomes. The stock is below the strike price. Option expires. All premium is total profit. I get to sell that call again. Because remember, I still own those shares. I could sell the call again. Stock price is above the strike price. The option is what's called exercised and premium is kept. Stock is sold at the agreed upon price. So if I sell the call at the price I bought it for, then I break even on the stock and I collect two premiums. Remember, I collect the premium for the cash secured put and I collect the premium for the covered call. Risk on this is the stock rises too fast and the gains are capped at the agreed upon price. So let's say I get the cash secured put. I have to buy it for 150 because the stock went to 148. I sell the covered call at 150, collect that premium, and then all of a sudden the stock's trading at 170. I lost on the difference between the 150 and the 170 because the covered call capped me at 150. That's the breaks for calls, for selling covered calls. Okay, here is where everybody gets tripped up. If you limit the premiums, total stock exposure is an easy rule of thumb to keep risk low regardless of volatility. So on earnings week, if they say, I will pay you 5% to buy my stock at 50. I'm like, no. Give me, what will you do for 1%? I don't want it. 5% sounds good, but I don't like the 50 price. It's too volatile. How about 47? I'll buy it at 47 for 1%. The chances that moves $3 is way lower than it moving 50 cents. That's why the 1% is a good rule of thumb. Even if you could get that premium, don't get it. Pull back to the 1%. Okay? Sell options on a weekly basis to deploy capital as quickly as possible. You don't want to have your capital tied up for 2, 3, 4, 5, 6 months. You want it freed up on a weekly basis. Limit exposure to less than 4% of your total portfolio. We'll look at this again, but don't if you have if you have $15,000, don't mess with Tesla at $150 a share, because you'll have to buy and sell 100 shares. That's what the options are for, 100 shares. So all your capital is in Tesla. Don't do that. Limit it to 4%. I limit mine to 4%. Limit underlying stocks names to undervalued high quality stocks with a price to earnings ratio in line or lower than the industry. And we'll look at that. Reevaluate underlying stocks on a weekly basis, replacing those that no longer meet the loss mitigation requirements. Okay, so you have to review your stocks. Have to. Like Palantir, great stock when it was first issued, was great for a year, and then it just tanked, and I took it off. I no longer mess with it. Okay, diversify underlying, not focusing too much capital in one sector. So diversify. Don't get all oil companies. Don't get all internet companies. That's the risk mitigation. This is probably the most important part of the strategy. So here's how you maximize profits. Okay, here's how I maximize profits. Margin accounts gives traders the ability to use unsettled funds immediately. So as soon as I sell, I don't have to wait 3 days. As soon as I buy, I don't have to wait 3 days for it to settle. They're mine, and I can do whatever I want with them when I want. Allows traders to borrow funds against stock positions, typically 50%. So if I buy Tesla stock at $100 a share, I only have to give them half the money for it. Okay, and if I want to keep it, then I only have to carry 30% of that money. Okay, I mean, this varies based on the stock. If it's a high risk stock, they'll make you, it'll be a full margin requirement, meaning you'll have to put up 100% of it. But by the most part, I don't mess with those. I only do the ones that let me hold the stock on margin or lower margin requirements. Okay, limit to 1%. That's what I do. But with a margin account, the profit can be significantly higher. And here's an example. 100 shares of Tesla in a cash account would require 120,000. In my account, it's less than 36,000, but you get the fees on the 120, not the 36. So I got 85,000 in capital, plus I'm getting the fees on the 120 and only using 36, so I'm making triple the 1%. So that's why I only pull back. I only do the 1% because I'm actually making 3% because of margin. Okay. All right. And these are the enclosures. These are all the statistics that I put in with the business proposal. Okay, and I'm going to show you some of those here real quick. So how do you decide on the stocks? Well, here's how you decide. I only do stocks under $50 right here. Stock price is currently at $50. Here's all the categories that they're in to make sure that I'm diversified. And here is this is a price target. This is what analysts think it's going to hit. Here's the current share price. Here's the value that's stored in there. So it's the difference between the share price and the target price. So they're all green, which means they all have upside potential. If I carried, it's all for 100 shares because that's what options trade. One option equals 100 shares of the underlying. Total, this is if I had to put up cash for all 100 shares. Even if I wasn't using margin, this would be the amount that it would cost to own these shares. Here's the percent total of my portfolio. It's only 4% here. 1%, 2%, 3%. So here's the averages down here. The average stock price is 34. The average upside is 28%. The average hold Average cost for 100 shares is about 3,500. The average exposure is only 3%. So if, let's say, this Newell brand goes to 0, I'm only down 3% or less. Okay, it's only 0.8 here. And then if I owned all the stocks simultaneously, my exposures, I would own 107,000 worth of stock, which that's not very much at all. I got a few times that in the account, so that's fine. And then here's my margin. Here's the margin requirement for each one of the stocks. It's 31%, which means I'm owning, the average is 3,500, but I only have to put up about 1,000 per position, which means instead of holding 107,000 of my money, they're only holding 32,000. That's the power of margin. Okay, so I'm using that strategy that I showed you on these stocks, and that's how I use mitigation, and that's what most of the trades are going to be. Covered calls, cash secured puts. I do some spreads from now and then, but that's it. That's the strategy. Simple, concise. That's what I use.